For the better part of 2 years, a single, simple assumption has underpinned almost every financial market decision. Interest rates go up, and then they must come back down. It's been the light at the end of the tunnel. But what if that's wrong? What if the second part of that equation doesn't happen anytime soon? What if we find ourselves in a higher-for-longer world, not just for a few more months, but for the next 3, 4, or even 5 years? The reality is, our economy, as it's currently structured, is simply not built to withstand that kind of prolonged pressure. Something, somewhere, has to give. The critical question then becomes, what breaks first? In this explainer, we are going to follow that chain reaction, domino by domino. But before we jump in, don't forget to like, share, and subscribe, and check out the links in the description if you're looking for a real estate agent in your market or you need life insurance. My team and I can help you anywhere nationwide.
All right, here's how we're going to break this down. Think of it as a series of interconnected events, a cascade. First, we'll establish the foundation for this whole discussion, the higher-for-longer premise itself. From there, we'll watch the dominoes begin to fall, starting with the most visible sector, the housing market. Then we'll move to a much quieter but perhaps more dangerous threat, the corporate debt wall. And finally, we'll see how all that pressure funnels into the banking system. After that, we'll tie it all together to understand the systemic risk and look back to see what history can teach us about moments like this.
So let's set the stage, because this isn't just an interesting thought experiment. This is a scenario that some of the world's most powerful financial institutions are now taking very, very seriously. They are operating on the assumption that central banks, like the Federal Reserve, will be forced to keep interest rates elevated, painfully so, for years to come. The goal? To finally crush a kind of stubborn inflation that just won't seem to go away. And if they're right, well, that changes the entire economic landscape. And just to give you a sense of the timeline we're talking about, take a look at this. This isn't a forecast for next quarter or even next year. JP Morgan, one of the largest banks in the world, is actively modeling a scenario where the Fed doesn't begin to meaningfully cut interest rates until 2027. Let that sink in. That's years away. This suggests we're not just in a temporary storm to be weathered, but rather a fundamental, long-term climate change for the entire global economy.
And this isn't some fringe view. It's a consensus that's rapidly forming. The core belief is that inflation has become so embedded in the system that central banks have no choice but to keep their foot on the brake. And you can already see this being priced into the real world. Just look at the mortgage market. Lenders and investors are now operating on the assumption that the average 30-year fixed mortgage will remain above that psychologically painful 6% mark all the way through 2028. This isn't speculation anymore. This is the new reality that businesses and families have to plan for. Okay, so with that as our baseline reality, let's turn our attention to the first and arguably the most visible domino to start wobbling, the housing market. There is no other sector of the economy that is as directly or as immediately sensitive to the cost of borrowing money. It's the canary in the coal mine, and it's where the pressure of these high rates first becomes obvious to absolutely everyone.
Now, a housing market under this kind of stress doesn't just collapse overnight. It happens in stages. In fact, we're already well into phase 1, the freeze. You've seen it. Transaction volumes have fallen off a cliff, down 30, even 40%. This is because of the dual problem of a massive affordability crunch for buyers and the golden handcuffs effect for sellers who don't want to give up their 3% mortgage. But here's the illusion. Headline prices look stable. That's only because liquidity has vanished. The real trouble begins in phase 2, as the pressure builds over time. That's when we start seeing regional cracks appear, especially in markets that were investor-heavy, like Austin or Phoenix. When rental income no longer covers the mortgage, investors are forced to sell. And that forced selling is what ultimately triggers phase 3, a true credit event, where builder defaults and delinquencies on home equity lines of credit start to pile up, causing significant price drops in those most vulnerable areas.
So, what are the odds of this actually happening? Well, if rates do stay high for years, analysts are putting the probability of regional crashes, that's significant double-digit price declines in specific cities, at a very high 70%. The chance of a broader nationwide crash is lower, maybe 40%, mainly because many parts of the country still have a severe housing shortage. And a complete 2008-style systemic collapse, that remains a low probability event, around 15%, with one huge caveat. That number goes way up if we see a major shock to the job market. So the key takeaway here is that the pain is unlikely to be evenly spread. It's going to be concentrated and regional.
Before we move on to the next domino, a quick reminder. If you're finding this analysis helpful, please take a moment to like, share, and subscribe. And if the housing market is on your mind and you're looking for guidance, check out the links in the description. My team and I can help you find a great real estate agent or get life insurance coverage anywhere nationwide.
Now, let's pivot to our second domino. While the problems in the housing market are on display for everyone to see, this next risk is far quieter. It's almost invisible to the average person, but it is lurking in the background, and it is potentially much, much more dangerous. I'm talking about the corporate debt wall.
Just take a moment to really process this number. Between the years 2025 and 2027, American corporations will need to refinance somewhere between $7 and $9 trillion of existing debt. This isn't new spending, this is old debt, taken on when money was cheap, that is now coming due. You can think of it as a tidal wave of maturing loans that is heading straight for a massive wall of much, much higher interest rates.
And here is the danger, boiled down to its simplest form. A company that borrowed money 5 years ago at a comfortable rate of, say, 3 or 4%, is now facing a new reality where they have to refinance that same debt at 7, 8, maybe even 10%. For tens of thousands of businesses, large and small, this means their single largest non-payroll expense, their interest cost, is about to double, or in some cases triple, almost overnight. This is a direct, brutal hit to their bottom line, and for many, it could be the difference between survival and bankruptcy.
And just like the housing market, this crisis unfolds in predictable phases. We're in phase 1 right now. It's subtle. You see it as margin compression in earnings reports, and you hear about it through quiet, rolling layoffs as companies try to absorb these higher costs. Phase 2 is when the debt wall actually hits, between 2025 and 2026. That's when we'll see a sharp acceleration in corporate defaults, especially in the high-yield or junk bond market. But phase 3 is where it becomes everyone's problem. This is the credit contagion. The losses from those defaults don't just disappear. They land on the balance sheets of the institutions that own the debt, pension funds, insurance companies, and that can directly threaten the retirement savings of millions. That fear then forces the entire banking system to pull back, restricting lending to everyone, even healthy companies.
And of course, this pain will not be felt equally across the economy. The most vulnerable sectors are those that either rely heavily on debt or operate on razor-thin profit margins. Commercial real estate is at the absolute top of that list. Right alongside are companies that were bought by private equity firms and loaded up with cheap debt. But it also includes everyday businesses in retail, restaurants, and logistics, and even certain healthcare and tech firms that were built on a model of growth at all costs, with no clear path to ever making a profit. They're all extremely exposed.
So we have a housing market that is frozen and beginning to crack. We have a corporate sector that is marching towards a massive refinancing shock. Where does all of this accumulated stress ultimately end up? It gets funneled directly into the core of our financial system, the banks, and specifically the small and regional banks that serve as the economic lifeblood for Main Street America.
It is so important to understand how banks actually get into trouble in this environment. It's not just about losing money on bad loans, though that's certainly part of it. The real killer is a fatal combination of two forces hitting at the exact same time. First, the value of the assets they already own, like long-term bonds, is falling because of high interest rates. And second, a loss of confidence from their depositors who get nervous and start pulling their money out. It's that classic liquidity mismatch, long-term assets versus short-term liabilities, that can cause a bank that is technically solvent to fail in a matter of days.
And the timeline for this stress is deeply interwoven with the other dominoes. In phase 1, which is happening now, banks are already feeling the pressure. Those unrealized losses on their bond portfolios are lingering, and their commercial real estate loans are starting to show the first signs of souring. Phase 2 is the big event, the CRE shock. When office property values fall by 30, 40, even 50%, regional banks who are heavily exposed will be forced to take massive, painful write-downs. And that event leads directly and catastrophically to phase 3, the credit crunch. This is the moment of maximum danger for the entire economy. It's when banks become so risk-averse that they slam the brakes on all lending, even to perfectly healthy businesses. They starve the economy of capital, and in doing so, they actively cause business failures and accelerate layoffs.
And when you start to look at the probabilities of these outcomes, it becomes quite sobering. Analysts see a 60% chance of more regional bank failures, a 50%, a coin flip, chance of a national credit crunch that drags down the entire economy, and a 30% chance of a full-blown systemic banking crisis. These are not small risks. These are the very scenarios that keep central bankers and policymakers awake at night.
So now, let's take a step back and connect all three of these pieces: the housing freeze, the corporate debt wall, the banking pressure. None of these events happen in a vacuum. They are all interconnected parts of a single, frightening chain reaction. the very systemic cascade that policymakers are working so desperately to prevent.
This slide lays out the sequence perfectly. This is the failure chain. It all begins with one thing: sustained high interest rates. That creates the corporate refinancing stress we just discussed. This, in turn, leads to a wave of defaults, which directly causes major losses for the banks holding that debt. The banks, in response, protect themselves by freezing all new credit. That credit freeze is what causes widespread job losses, as businesses can no longer fund their operations or expansion. And finally, what happens when a large number of people lose their jobs? They can no longer afford their mortgages. And that is the trigger that can turn a regional housing problem into a full-blown national housing crash. You see how every single step logically leads to the next?
So how do the people in charge know if we're getting dangerously close to the edge? They monitor a master dashboard of critical economic indicators, very much like this one. They're watching for mortgage rates to stay above 7% for a prolonged period. They're watching the default rate on high-yield debt to see if it takes above 6%. They're watching commercial real estate prices to see if they fall more than 25%. When several of these key indicators start flashing red at the same time, that's the signal that the system is approaching its breaking point.
At this point, you're probably asking yourself, has a scenario like this ever actually played out before? Is there a historical precedent? And the answer is an unequivocal yes. While no two economic cycles are ever exactly the same, history offers some very clear and very sobering examples of what happens when financial conditions tighten this dramatically for this long.
You can look back to the 1970s and the secondary banking crisis in the UK, a textbook example of a commercial property bubble that burst under the pressure of higher interest rates, which led to a cascade of bank failures. Or consider the 1994 bond market crisis, sometimes called the Great Bond Massacre, which demonstrated just how violently an unexpected and rapid rise in rates could shock the entire global financial system. You can even go as far back as the 1930s to see the disastrous results when housing affordability becomes completely misaligned with the underlying economy. The historical pattern is undeniable. Sustained, severe rate pressure eventually breaks something important.
And this all brings us to the final and perhaps the most crucial point of this entire analysis. We have been conditioned to think of the Federal Reserve cutting interest rates as a celebration, a sign of victory, a declaration that the war on inflation has been won. But history tells a profoundly different story. Far more often than not, rate cuts are an act of pure desperation. They're the financial equivalent of a defibrillator, an emergency response to a crisis already in progress. This is why almost every major recession in modern history ends with the Fed cutting rates, not because inflation has gracefully returned to its target, but because something in the economic machine has finally buckled and broken under the immense pressure. And so the ultimate question for us today is not if something will break in a higher for longer world, but rather what breaks first, when does it happen, and how severe will the consequences be? If this explainer helped you understand the powerful forces shaping our economy, please like, share, and subscribe. And for help navigating your own financial future, whether it's real estate or life insurance, click the links in the description. My team and I are here to help nationwide. Thank you for watching.